Welcome back to the AlgoBot channel, where we break down automated trading strategies for MetaTrader 5, one idea at a time. I'm AlgoBot, and today we're exploring an expert advisor called Ultimate Smoother Trend Cross. This strategy is built on a modern filter designed by the engineer and trader John Ehlers, the Ultimate Smoother, and it uses a familiar fast line over slow line crossover to follow trends. Over the next few minutes, you'll learn how the smoother works, how the entry and exit rules are wired together, and how the strategy reads a chart. Remember, this is educational information only, and it is not financial advice. Let's get started. Ultimate Smoother Trend Cross is a trend-following expert advisor for MetaTrader 5. At its heart sits a tool published by John Ehlers, called the Ultimate Smoother. A traditional moving average smooths price by averaging it, but averaging always introduces lag, so the line reacts late. Ehlers Smoother takes a different route. It is a recursive filter that subtracts a matched high-frequency component from the raw price, which means it strips out the small, choppy wiggles while keeping the larger trend movement almost perfectly in step with price. In plain terms, it aims to give you a clean line with very little of the delay you normally accept from a moving average. The strategy runs two of these smoothers side by side. One is set to a shorter length, so it reacts quickly and hugs price. The other is set to a longer length, so it moves slowly and represents the underlying trend. When the fast line climbs above the slow line, the reading is bullish. When it drops below, the reading is bearish. That is the same intuitive picture as a classic moving average crossover, but because both lines carry less lag, the crossings tend to appear closer to the actual turning point. On top of the crossover, the strategy adds a slope filter. The slow line must be sloping in the direction of the trade over a set number of bars, which helps ignore crossovers that happen in a flat, going nowhere market. Risk control is handled with the average true range, a common measure of volatility, so the stop loss and take profit distances adapt to how active the market currently is. It works on any single time frame you choose, and it treats long and short trades symmetrically. This design tends to appeal to traders who are studying trend-following systems and low-lag filtering. This is for educational purposes only. Let's walk through the exact logic. The strategy only makes decisions once per bar at the moment a candle closes. That completed candle is what drives every calculation, which keeps the signal stable and avoids reacting to a bar that is still forming. On each new bar, the EA updates two ultimate smoother lines from the closing prices. The fast smoother uses the FastPeriod input, which defaults to 20. The slow smoother uses the SlowPeriod input, which defaults to 50. Now the entry rules. For a long signal, three things must all line up. First, the fast smoother must cross above the slow smoother, meaning it was at or below the slow line on the previous bar and is now above it. Second, the slow smoother itself must be rising, measured by comparing its current value to its value a set number of bars back. That number is the SlopeBars input, which defaults to 3. This slope check is the regime filter, and its job is to reject crossovers that happen in a flat market with no real direction. Third, the latest close must sit above the fast smoother, so price itself confirms the move. The short signal is a mirror image. The fast smoother must cross below the slow smoother. The slow smoother must be falling over the SlopeBars window, and the latest close must sit below the fast smoother. Only when all three agree does the strategy signal a short. Position handling is straightforward. If an opposite signal appears while a trade is open, the strategy closes that position and reverses into the new direction. If a signal points the same way as an existing position, it simply stands aside because it is already aligned. Finally, risk is defined with the average true range. When a trade opens, the EA measures the current ATR and places the stop loss at that ATR multiplied by the AtrMultSl input, which defaults to 2. The take profit is placed at the ATR multiplied by the AtrMultTp input, which defaults to 3. With those defaults, the target sits farther away than the stop, giving a reward to risk shape of 3 to 2. Because both distances scale with volatility, the strategy widens its brackets when the market is active and tightens them when it is calm. Remember, trading involves risk, and losses do occur. Here's the core of the MetaQuotes language code, the same file the expert advisor actually runs. At the top are the inputs you can adjust in the strategy's settings. FastPeriod and SlowPeriod set the lengths of the two ultimate smoothers, 20 and 50 by default. SlopeBars, defaulting to 3, is how many bars back the slow line is checked to confirm it is sloping the right way. ATR-period sets the volatility look back, and ATR-multiple-SL and ATR-multiple-TP turn that volatility into stop-loss and take-profit distances. Lots is the order size. Below the inputs are the signal conditions, and these are evaluated on the just completed bar. The variable cross-up is true when the fast smoother was at or below the slow one and is now above it. Cross-down is the opposite. Slope up and slope down compare the slow line now against its value several bars back. The long signal line combines a cross-up, a rising slow line, and a close above the fast smoother. The short signal line requires a cross-down, a falling slow line, and a close below the fast smoother. Now look at the two order blocks. When the long conditions are met, the code reads the ask price, sets the stop-loss below the entry by AtrMultSl times ATR, sets the take-profit above the entry by AtrMultTp times ATR, and calls trade.buy with those levels. When the short conditions are met, it reads the bid price, places the stop above the entry, the target below it, and calls trade.sell. Notice that both sides are perfectly symmetric, just with the stop and target flipped. That symmetry is a hallmark of a clean, direction-neutral trend follower. This is educational information, not a recommendation. Let's bring the rules to life on this illustration. On screen, you can see a candlestick chart with two lines drawn over the price. The lighter, quicker line is the fast ultimate smoother, and the smoother, steadier line beneath it is the slow ultimate smoother, our trend baseline. Watch how the two lines behave as the market moves. At the far left, price is drifting lower. The first two candles close red, and the fast line sits below the slow line. So the reading is bearish and the strategy stays flat. There is no crossover to act on, and importantly, the slow baseline is still pointing down. So even if a crossover appeared here, the slope filter would hold the strategy back. Around the third candle, the selling loses steam. Price makes a low and starts to stabilize, and you can see the slow baseline flatten out and begin to curl upward. This is the market catching its breath. The fast line, being more responsive, turns up first and starts closing the gap toward the slow line. Now watch the fifth candle. This is the setup the strategy is waiting for. The fast line crosses above the slow line. The slow baseline is now clearly rising over the last 3 bars, and the candle closes above the fast line. All 3 long conditions agree at once, and the buy entry marker appears. This is the moment the strategy signals along, catching the trend early thanks to the low lag of the smoother. From there, the trend unfolds. The 6th, 7th, and 8th candles print a clean run of higher closes, and both lines rise together with the fast line leading. The stop-loss was placed below the entry at a multiple of the average true range, giving the trade room to breathe, while the take-profit was set farther above at a larger multiple. As the 8th candle pushes into new ground, price reaches that take-profit target, and the long trade is booked as a win in this illustration. Notice the reward-to-risk shape here, with the target set at 3 units of volatility against a stop of 2. Then the character of the market changes. The 9th and 10th candles stall near the highs and start to roll over. The fast line flattens and turns down, and the slow baseline, which had been climbing, rounds off at its peak. Price is losing its upward push. By the 12th candle, the mirror image setup completes. The fast line crosses below the slow line. The slow baseline is now falling over the last 3 bars, and the candle closes below the fast line. All 3 short conditions line up, and the sell entry marker appears. Because the strategy had been flat after the target was hit, it simply opens a fresh short here. Had it still been long, this same signal would have closed that trade and reversed it. The downtrend then plays out just like the uptrend did, only inverted. The 13th and 14th candles close lower. The 2 lines slope down together, and the fast line leads the way. For this short, the stop-loss sits above the entry and the take-profit sits below it, again at those same volatility multiples. As the 15th candle prints a fresh low, price reaches the downside target, and the short trade is completed in this example. Step back and look at the whole picture. In both trades, the strategy waited for 3 separate conditions to agree before committing: the crossover, the slope of the baseline, and the close relative to the fast line. That layered confirmation is what helps it lean toward genuine trends and away from the flat, choppy stretches. Of course, not every signal will behave this cleanly in live markets, and losing trades are a normal part of any approach. So that's the ultimate smoother trend cross expert advisor. We covered the idea behind John Ehlers' Ultimate Smoother and its low-lag design. We walked through the fast-over-slow crossover with its slope filter and close confirmation. We read the core meta-quotes code for both the long and short sides, and we watched a full long and short sequence play out on the chart. As always, everything in this video is educational information only, and nothing here is financial advice, a recommendation, or a solicitation to trade. Markets carry real risk, and losses are a normal part of trading. If you found this breakdown helpful, please like the video, subscribe for more MT5 strategy analyses, and leave a comment with the strategy you'd like us to cover next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.